Good afternoon, and thank you for joining us for today's webinar, 5 Trends to Discuss with Your Board and Owners in 2025. My name is Sean O'Brien, President of QuickRate, and I'm pleased today to be joined by Christian Appleby. Christian is with Siena Capital Partners, and he's going to take you through the presentation today. A couple of housekeeping items before we get started. You will receive a copy of the slide deck and a recording of the presentation today and a follow-up email that'll likely go out tomorrow or Thursday. If you have questions, we certainly welcome those throughout the presentation or at the end. You can use the chat feature or the Q&A selection as well. Again, we're going to turn the presentation over now to Christian, and he's going to walk you through. Christian?
Thanks, Sean. And thanks so much, everybody, for joining today. So when Sean and I were discussing ideas for this presentation, we felt like it would be most impactful to walk you through a handful of trends that we're seeing and observing affecting the industry, and provide you with an opportunity to have dialogue around them and think about how, to articulate and communicate these trends to your board and shareholders. So we'll make as Sean mentioned, we'll make the presentation available after the fact. Please take the time to read the disclosures. So before we jump in, a bit about myself and my vantage point on this industry. So I joined Siena Capital Partners almost 10 years ago, and during the course of my time at Siena, I've engaged in hundreds of conversations with management teams, investors, industry contacts, and boards, all around topics like the ones we'll be discussing, how those trends are affecting the performance and the challenges and opportunities of community and regional banks. Finally, I'll just note that Siena Capital Partners is an institutional investor focused exclusively on the community and regional bank space. During my time at Siena, I've overseen investments representing approximately $1 billion in transaction value, exclusively focused on the industry. So before I jump in and start talking through the topics for today, I just wanted to note that I'm going to aim to go through the topics at a relatively high level, and I want to open up the basically another thing I wanted to note is just I'm happy to speak one-on-one with any bank management team. Happy to speak with boards as well on any of these topics. So I'll make my contact information available after this presentation, and basically we want to be a resource for just the industry generally, and provide feedback and answer questions so that we can help you as you're out there building your company. So the first trend that I wanted to highlight today is, as we all know, the past several years from the perspective of earnings. So the dark blue bar is earnings for all banks under 20 billion in assets. That's pre-tax, pre-provision net revenue. So over the past several years, starting in 2023, we'd seen an unprecedented slowdown in earnings growth. So prior to those years, we saw a pretty consistent 5, 7, 9% growth year over year in earnings, and there was a pause here that we've hit. So it's been a challenging time in that regard, and one of the major causes, which I've highlighted with these stars here, is the shape of the interest rate curve. So we over 2023, 2024, we experienced an unprecedented inversion. Here I've used the Fed funds rate, less the 5-year Treasury rate. And so, the idea is for spread lenders, which smaller banks generally are, community and regional banks, it's been a challenging time. The last thing I'll note on this slide is just not only this is the forward or futures curve, not only is the expectation that we'll get back to a healthier spread, but also industry analysts are projecting, this is trend earnings, the green. Industry analysts are projecting that we'll have higher than trend growth in the coming years as we approach closer to trend levels of earnings for the industry as a whole. So I'll stop there. Those are the quick highlights. And, if there are any questions on this, I'm happy to address those now. And if not,
Yeah.
we can certainly save some time at the end. Oh,
Yeah,
okay.
Christian, one question came in. How does the earnings recession of the 2022, 2023, kind of compare to COVID and the financial crisis recession?
Yeah. So I think I got that. Basically, we had a recession, and I framed it as an earnings recession here over the past several years. How does that compare to the past few recessions we've had? So that was COVID and great financial crisis. So I think the biggest thing that stands out as we have looked at it has been this unprecedented inversion in the curve, and that's sort of what I described here. It's a lot more challenging to generate earnings growth, as I know we're all seeking to do when that happens. So it's not only the depth of it, but the length of it. Second, I think in this most recent downturn or earnings recession, we saw the unprecedented liquidity, which we'll actually touch on later in the presentation, come into the system. This was around the 2020, 2021 timeframe, and that rippled through in a really unique way, and ultimately contributed to what you see here. So yeah, I'll keep moving, and if there's any more questions on this topic, we can touch on them at the end. So the second point I wanted to note, if you're framing this for your board and owners, the first slide is kind of geared at what the industry as a whole has experienced over the past several years, getting into the nuances of that, and talking about some things that are happening industry-wide that could affect performance of your bank. So like a several year look back. Well, this is 2 decades here, this chart, and it's just net interest margin for all banks under 20 billion in assets. And as you can see, there's a multi-decade downward trend here that's evident. So I won't go into too much detail other than to highlight just there's 2 steps here that I pointed out. There's the post-GFC step down, and then there's the kind of post-COVID step down. And big picture overarching theme is the balance sheets have driven this, right? There's a contribution from the interest rate curve, but following the great financial crisis, we saw a lowering of loan to deposit ratios, a lowering of reliance on wholesale funding, and a pullback in participation in some higher yielding loan categories, such as higher risk construction lending, and then also an increase in cash and securities as a proportion of the balance sheet. So that was the key step down here. And then I'll just finally note, we saw another step down here, again, driven by balance sheets, but we've seen a pickup in just how the margins have been moving. And that's been driven by the curve inversion. So this volatility here, driven by that, step down by predominantly balance sheet composition again. And there's signs or evidence that we sort of hit a bottom, and the trend will show through in the next year or so as some of these effects start to work their way out of the system. So again, I'll stop here, and if we do have a question or two, great, but if not, we can keep rolling.
Yeah, one we do again. Just kind of again, could you kind of explain the biggest difference or the what's holding NIM back today versus prior to 2020?
Yeah, it's a good one, and I think that, as you can see here, this process, this step down after the great financial crisis, It was a gradual drift and it was longer in duration, right, than what we've experienced to date. Um, this has been more dramatic and, there's, again, more volatile. And so what's been driving that? I think that coming out of 2020, we had significant liquidity coming into the system, and particularly like throughout 2021, the level of the curve was low. So if you were investing in loans or securities at that time, and particularly if duration was stretched, right, that was a headwind, right? Well, during the great financial crisis, uh, it played out on a much slower pace, and it was related to kind of a just general de-risking of the banking industry. So I think this time around, much more driven by the liquidity, the volatile liquidity, and the interest rate environment being much more volatile and making it tougher, to find margin out there. So, okay, so this is top of mind for a lot of people, and we track and follow hundreds of call reports each quarter, and are looking for signs of credit normalizing. Right, we had basically an incredible trough in charge-offs and NPLs during the 2020-2021 timeframe. And we're just currently working off a bottom, right? And just looking for a clear line of sight on what the destination is, right? So the biggest trend that I'll highlight here, and we can get into it more in the Q&A, but I'll just note that the data that we track, the non-banks, there's certain segments that are showing clear signs of a lift in credit costs and NPLs, things of that nature. And with banks, both large and small, and life insurance companies, we're working our way off the bottom, but it's been a gradual move, and it's been it's been much less dramatic. So yeah, I'll keep the highlights to that. If again, I'll just give an opportunity for questions if there are any.
Yes, there is one. What do you think, what would you focus in on for the credit slide, or hypothesize why the credit slide in the non-banks is higher than banks?
Yeah, it's a great question. It's something we thought about a lot. I'll I'll sort of frame it this way. It's like ticket size, like the size of the loans has been a key correlate. So the larger the loan, the greater the propensity for default. That's what we've observed this cycle to date. And commercial real estate REITs and commercial mortgage-backed securities, they just have larger average ticket sizes, right? Another thing I'll note is just the importance of recourse lending, which is much more customary in the banking industry, to the probability of default, right? So recourse is just one part of it, or personal guarantees, that sort of thing. But at the end of the day, it's that having a line of sight into your customers, is really important, and just kind of being aligned with customers. So those are just two observations on why we think this is. So.
One other question came in, Christian. Do non-banks incur higher losses because of their lack of government regulations?
um, I can speculate or give some thoughts. We've noticed in our conversations that yes, being regulated to the extent that banks are, does affect outcomes, right? I think that it's also like a sort of, I'll call it like a selection bias, right? Like if you're like a borrower that wants to do a lot of kind of like high velocity, non-recourse business, your risk tolerance, right? Um, you know, because and being regulated is one cause of this, right? Or a reason why this is. Banks are generally, they have a reputation for being more conservative. you're going to slide out of the banking system, right? So, but yeah, I think that's a great idea, and I think there's likely truth to that based on the feedback we've gotten over the years. So, well, I'll keep moving forward, and we can save more time in the Q&A if anything related to credit is top of mind for everyone here. So, okay. I won't spend like a ton of time on this. I just wanted to note though, it's sort of the big question that we think about where are valuations and stock prices headed. So term average, I've got that at 20 years here. A couple decades is 15 times price to last quarter annualized EPS. The current price to consensus 2026, which is the estimated 2026 for the industry is under 10 times earnings. So, over time, we've observed that the level of earnings is important for the value of your bank. This doesn't just apply to publicly traded companies, but every bank has a value, right? Even private banks. You just can't see a daily quoted price if you're private. And so the thought is, the idea is that there's a lot of potential that isn't reflected in current prices, and there's an opportunity here when you pair it with like a reversion to the trend in terms of earnings growth, but also a reversion to historic valuations. Just one way of capturing that, and I won't go into it much more than that. But Sean, I wanted to ask, was there anything on this slide, or should we keep pushing forward?
No, we can keep pushing forward.
Great, yeah. So finally, M&A, like the conversation wouldn't be complete without a slide on it. I've noticed a lot of analysts will start with top-down data, nationwide data. Here's how many deals have happened. Here's the valuation of these deals, and things like this. I wanted to take a bit different of a lens. Like in my experience, just engaging in these types of discussions, and in a prior life, actually advising on these deals and opportunities, the value of your bank or a competitor, right? In the context of M&A is really driven by how motivated the top few buyers are, and it's very regionally defined, right? But also where they're trading, what their valuation is. So the last thing I'll note is there's a capacity, right, to take on M&A. And so I've highlighted, some top buyers in each of the four major regions. And the stars just indicate they've announced an acquisition in the last 12 months. So it's an indication, like all of these banks have done one acquisition in the last 5 years. But if they've done one in the last 12 months, it's an indication that they're active and they have an active practice in doing this, but also capacity is something to consider. So, you know, just all else equal, the closer in size the two banks are that have recently merged, the less and the bigger commitment it is as an organization. So I just wanted to say this is not just
Christian,
relevant.
could you repeat that? You were breaking up there. What was the last comment that you made there?
Yeah, happy to. So I was just saying that capacity, right? So if the larger in relative size these two banks are that recently merged, the less capacity they'll have to do more acquisitions in the coming year or two, because it's just a lot more to take on as a company. So yeah, I'll just final note here, not just relevant in the context of a sale of your bank or a competitor's bank. It's relevant insofar as if an acquisition or a merger happens in your market and you understand the style and the approach of some of these active buyers, you can just learn a lot when it comes to the types of, typically it's opportunities, right, for your bank if you're not the participating bank. But there could be challenges too, extra competitive pressures, that sort of thing. So, yeah, I'll leave space in the Q&A. The last thing I'll just note is that The one topic I haven't touched on here at all, but is top of mind for a lot of folks, is credit union acquisitions of banks. So I think it is valuable to, there's 5,000 credit unions out there. There's only a few hundred active credit union buyers. It is valuable to learn about their style, their approach, and to get to know the people, because they become increasingly a competitive force, for community banks in recent years. So yeah, I'll stop there. And before we jump into the Q&A, I just wanted to note again, I'm happy to make myself available one-on-one. I'm happy to speak to management teams, boards, anybody engaged in this industry, particularly, for our network here at Quick Analytics and Quick Rate. We just want to be helpful and make ourselves available and just be a resource. So if you have any follow-up and you prefer kind of a one-on-one format, I'm happy to do that as well. So
Great. There are a couple questions, Christian. First up, can you describe any key trends that you saw in the M&A market over the past few years?
yeah, so this slide, um, I purposefully focused on individual buyers, who's the most active, who's recently done acquisitions. So we can take a step back and talk about M&A generally. Um, so the major trend that everybody is talking about is just a very pronounced slowdown in the number of acquisitions that are happening annually. This started in 2020. We had a bit of a relief in 2021, but the trend has continued in recent years. Another thing to note is that the percentage of credit union acquisitions within that number. So we were at like an average of 250 acquisitions annually prior to COVID. Now it's closer to 100 to 150, kind of a run rate, and a much larger percentage of those are credit union acquisitions. So valuations have been kind of stop start, over the past several years. But there's um, evidence to support that we're getting closer to like that long-term average of it's about 1.5 times tangible book. But it's a moving target, particularly the valuation. So finally, I'll just note with M&A, a trend or challenge has been the balance sheet marks. They become much more significant as a percentage of capital and in terms of what the earnings are for the combined bank going forward. So just there's a sense that we need more time to let some of that healing happen and the balance sheets to turn over before we really uh, get going. And I could talk about this topic for a long time, but the final thing I'll note is just approval timelines. They were extended significantly during the Biden administration. And although it's early days, there's evidence to support that we're headed towards a more streamlined process under the current administration with shorter approval timelines, particularly for larger acquisitions. So
Just as a follow-up, then, are you anticipating that the pace, for this year and next for M&A to be about the same, or do you expect it to hopefully increase or increase its pace?
yeah, so you know we haven't seen um, significant, sort of like tangible signs of there being a pickup from last year to this year. I think the thought is as the backlog of approvals kind of cures out, we have because of these longer approval timelines, we have a large backlog of unapproved deals, and there's been hesitancy to pursue acquisitions because of just it's disruptive, right? If it takes 12 plus months to approve a deal. Um, so I think the thought is as that has time to cure out, and as the balance sheets have time to turn over, particularly assets, securities and loans, and the marks become less onerous, that there's a compelling case to be made that next year and the following year, basically it won't be a flood, right? But there'll be a nice step up.
Yeah. One other question that's come in is what's the most important ratio or ratios that you look at when reviewing M&A?
Yeah. So, I think that in my mind, it's known as pay to trade. So it's basically where the target, where the purchase price of the target compares to the buyer. And why is it so important? Well, it tends to be the governor over time of the acquisition, like the valuations of the targets. So one of the reasons that we've had much lower than trend valuations for targets in the past couple of years is because the publicly traded buyers are also trading at very low valuations, right? So, but I think the one thing I'd like to impress here is that when we're looking at M&A, we're often thinking about risk, and risk is actually, we get a sense for that by looking at like the relative sizes of the banks, the geographies of the banks, the things like the management of the future company, and the fit, just the overall fit between the two banks. So, but yeah, basically the metric I like to look at over time is pay to trade because it does drive the prices of these acquisitions. But a lot of when we look at the merits of an opportunity is actually related to some of those other factors that don't really have clean metrics, so.
Okay. Just again, a reminder to go ahead and use the chat feature or the Q&A feature if you have any additional questions. Not seeing any more. Christian, any final thoughts or comments before we let everyone have their day?
Yeah. So, I wanted to note that this is just one other opportunity and resource that we make available for not just our quick rate and quick analytics customers, but just anybody engaged in this space. So, I'm happy to make myself available and, speak with management teams, boards, that sort of thing. If anything from today's session sparked a thought, or if you have any follow-up, please don't hesitate to reach out. So.
Great. Well, thank you all very much. Thanks to Christian for joining us today. We'll be back with next quarter with another topic, but appreciate everyone joining us today and for the questions. And we'll look forward to speaking to you again. And as Christian said, if you have any would like to meet with him, just reach out and we will get you in touch with him. And look again for a copy of the slides and a link to a recording in the next day or two. Thanks again. Appreciate you joining us and have a great day.
Thanks, everyone. Take care.